Hi everyone, Neža here, and welcome to Stock Break, where I give an in-depth analysis on public companies in under 5 minutes, breaking down their fundamentals and potential valuation. Let's dive in. Hello and welcome to a new episode of Stock Break with me, Neža Molk. Today we will talk about the biggest home improvement retailer in the world, that's Home Depot. Now, the big question for today's episode is company still building success, or are there any challenges lying ahead for them? But as always, just a quick reminder before we start, this presentation is for educational purposes only, and it should not be taken as investment advice or recommendation to buy or sell any financial instruments. Now we can dive in. Home Depot started as a bold idea in 1978 to create a store where DIYers and pros can find everything for home improvement and also expert advice to really make it happen. So built from scratch really suits them. It started as 2 stores in Atlanta, Georgia, but it quickly gained popularity, and now they have more than 2,300 stores all across US, Canada, and Mexico. They're selling everything from tools, garden supplies to viral holiday decoration, and their online shopping platform only adds to the convenience and popularity of the company. Looking at their stock performance, the company is up about 18% year to date, and it is trading just below all-time high that it reached in December 2021. The company also released third quarter earnings report last week. They reported earnings per share of $3.67 on $40 billion revenue, which exceeded market expectations. Nevertheless, their comparable sales declined by 1.3%, but this number was still much lower from what analysts expected. They even increased full-year outlook. Now they are expecting sales to increase approximately 4% in 2024. They are remaining cautiously positive about the future. They still see a big impact of high interest rates on their customers, but nevertheless, they see a higher potential for their sales in the future as interest rates begin to ease. When analyzing a retailer like Home Depot, there are a few metrics that we cannot skip, and today we will take a look at 3 of them. First, we're gonna take a look at their profitability. Here we have gross margin and net margin on the same graph. As we can see, they are both very stable through the years or even improving. Gross margin is standing at about 33% and net margin is standing at about 9 or just under 10%, which are very solid numbers, and they are both above industry averages. The second metric that we're gonna take a look at is same-store sales growth. I always take a look at this metric when analyzing any retailer company. I look at it because this number measures revenue at stores that have been open for at least a year. And as we see from their data, we can see that same-store sales growth for Home Depot has been negative for the past 8 quarters. In the latest report, they reported a decline of 1.3%, which was much better from expected decline of 3%. But the company is still struggling with big ticket items. Those items are selling for over $1,000 US, and comparable sales for those items are down 6.8%, which can clearly demonstrate that people are still hesitant on big remodeling projects. Nevertheless, even if their same-store sales growth hasn't been on their highs in the past quarters, their stock is still performing well, and they are anticipating higher growth in the future. Now, the third metric that we're gonna take a look at is their inventory turnover. It currently stands at about 4.4, and what does this number tell us? It means that they are selling and restocking their inventory somewhere between 4 and 5 times a year. This is a sign of strong demand and smart inventory management, which is keeping their shelves fresh, and it's good for their business. But on the other hand, Home Depot is really focusing on physical stores, and all of that requires higher logistic costs and higher storage compared to some of their competitors, which are focusing more on their online business like Amazon. Speaking of Amazon, it is one of their main competitors due to their low cost and ultra convenient approach with online shopping. But there are also some other competitors like Lowe's, which is appealing for people looking for more home decor options. And then there is also Walmart, which is a go-to for budget-friendly home essentials. But what sets Home Depot apart from them is this in-store experience with a strong focus on professionals like contractors, but also everyone that is doing a DIY projects can find everything they need in their stores. And this is a big win and something that sets them apart from other retailers in the business. Now that we know a bit more about the company, we can continue with valuation. The company's future holds promise that is supported by several different tailwinds. One of them is definitely Federal Reserve cutting interest rates, which could boost housing market and with that drive demand for home renovations. Because of that, Home Depot could finally see a positive number in same-store sales growth, and this would definitely be a positive news for the company. Another important factor to consider is acquisition of SRS Distribution Company, which was finished this year. It gives a boost to their pro segment and more exposure to contractors and professionals in the industry, and we could definitely count this factor as important for their future growth. Besides that, the company has a solid 2.2% dividend yield, which has been growing for the past 15 years, and that makes them a solid option to consider, especially for income-focused investors. That said, the company faced quite a few challenges in the past few years. First, there was pandemic, which pulled lots of demand for home improvement from the market. Then there was high inflation and increasing interest rates, which have slowed housing turnover to 30 years low. That being said, Guru Focus currently ranks the company as modestly overvalued with forward P/E ratio of about 26, which is near the higher end of their historical range. While this valuation reflects confidence in potential turnaround of economy and company itself, it also limits short-term upside potential. I think investors should evaluate potential growth prospects for the company before deciding to invest, even though the company can provide you a stable dividend and has a very solid financials. That's it for Home Depot. I hope you enjoyed this episode, and don't forget to like, share, and subscribe if you would like to see more content like that. Let me know in the comments which company would you like to see in next episode, and see you next time.